Ladies and gentlemen, welcome back to the channel. In today's analysis, we are looking at a story that on the surface sounds almost impossible. A country has been hit with the most aggressive tariff wall in nearly a century. Its biggest trading partner has slapped 50% duties on its steel, 50% on its aluminum, 50% on its copper, 25% on its automobiles, and on top of all that, 10% on softwood lumber and 25 to 50% on furniture and cabinets. The President of the United States has personally threatened this country with 100% tariffs if it dares to sign a trade deal with Beijing. And yet, despite all of this economic pressure, that same country has just been declared the second fastest growing economy in the entire G7. The country, of course, is Canada. And what I want to break down for you today is not just the numbers. It is what this development really means for Mark Carney, what it means for Donald Trump, and what it tells us about the future of North America. Let me start with the hard facts, because I want to be clear about what is actually happening versus what is being spun on both sides of the border. According to the International Monetary Fund, Canada is now projected to post the second fastest real GDP growth in the G7 over 2026 and 2027, trailing only the United States. The IMF expects the Canadian economy to grow at an annual rate of 1.5% this year and 1.9% in 2027. That is faster than Germany, faster than France, faster than Italy, faster than Japan, faster than the United Kingdom. Finance Minister François-Philippe Champagne announced this in the Spring Economic Update 2026, titled Canada Strong for All, which was tabled in the House of Commons on April 28th. And here is the part that surprised even seasoned economists. The projected deficit for 2025 to 2026 came in more than $11 billion lower than what Budget 2025 had originally forecast. $11 billion better than expected. Champagne said in the House of Commons, and I am quoting from the official transcript, that Canada has built the second fastest growing economy in the G7 while reducing its projected deficit for 2025 to 2026 by more than $11 billion. Now, before anyone in the comments accuses me of cheerleading for Ottawa, let me state the obvious. This is a government press release framing, and like all government framings, you have to look underneath the headline. So let me do that for you right now. The IMF's 1.5% growth projection for Canada in 2026 is, in absolute terms, not impressive. It is actually below the global average. And the same IMF report notes that the United States is growing at roughly 2.3%, well ahead of Canada. So when Champagne says second fastest, what he really means is second fastest among 7 slow-growing wealthy economies, most of which are barely growing at all. Germany at 0.8, France at 0.9, Italy at 0.5, Japan at 0.7. Compared to that, 1.5 is a hero. Compared to a healthy emerging market, 1.5 is barely keeping the lights on. So context matters here, but, and this is the part that genuinely surprises me as someone who watches this trade war closely, the fact that Canada is growing at all under these conditions is the real story. Let me explain why. Going back to early 2025, almost every serious economist on this continent predicted that Trump's tariffs would push Canada into a recession. The reason was simple. Roughly 20% of Canada's gross domestic product is tied to exports to the United States. When you slap 35% tariffs on top of that, when you target steel, aluminum, autos, lumber, and furniture, you would expect the Canadian economy to crater. And early in 2025, it almost did. The Bank of Canada was bracing for contraction. Business investment fell. Job losses began piling up in Hamilton, in Windsor, in Saguenay. The auto sector, the steel sector, the aluminum sector were taking real damage. So how did Canada avoid the recession? This is where my analysis comes in, because I think the answer is more interesting than either Carney or Trump want you to know. There are 3 factors at play here. The first factor is the CUSMA exemption. Despite all the noise out of the White House, the vast majority of Canadian exports to the United States are still compliant with the Canada-United States-Mexico Agreement, which Trump himself signed in his first term. According to the official Spring Economic Update document, Canada continues to enjoy the lowest average tariff rate among all major United States trading partners at 5.2%, 5.2, Compare that to what China is facing, what the European Union is facing, what India is facing. The headlines say 35%, the headlines say 50%, but for the bulk of cross-border trade, especially in energy, in agriculture, in most manufactured goods, CUSMA is still doing its job. Trump can rage on social media all he wants, but he has not actually dismantled CUSMA. Not yet. Looking at the bigger picture, this is one of those situations where the political theater and the economic reality have drifted apart. The second factor is what I would call the diversification dividend. Carney has spent the last year aggressively trying to reorient Canadian trade away from the United States and toward Europe, toward Asia, toward Latin America. In an address to the nation released on April 19th, Carney told Canadians, and again I am quoting from the official transcript, that the United States has fundamentally changed its approach to trade, raising its tariffs to levels last seen during the Great Depression. He said that many of Canada's former strengths based on close ties to America have become weaknesses that must be corrected. That is a remarkable statement from a Canadian Prime Minister. For decades, Canadian leaders have framed the relationship with the United States as the cornerstone of national prosperity. Carney has officially declared that cornerstone a liability. And what is being built on top of that declaration is a major projects office supercharging 15 nation-building projects projected to create over 60,000 jobs and $126 billion in new investment. There's a new sovereign wealth fund called the Canada Strong Fund, seated at $25 billion. There is a productivity super deduction to attract foreign capital. There is a goal of doubling exports to non-United States markets within a decade. This is, in policy terms, an attempt to permanently reduce dependence on the American market. And here is the kicker. According to the Spring Economic Update document, Canada led the G7 in per capita direct investment inflows in 2025. The world is putting money into Canada faster than into any other G7 economy on a per-person basis. That is not a small detail. That is global capital voting with its wallet. The third factor, and this is the one I find most important from an analyst's perspective, is the domestic resilience play. The Carney government has deployed massive fiscal firepower to absorb the tariff shock. We are talking about a $1 billion loan program announced on May 4th by Industry Minister Melanie Joly, specifically for steel, aluminum, and copper businesses hit by Trump's tariffs. We are talking about another $500 million added to the Regional Tariff Response Initiative for small and medium enterprises. We are talking about a defense industrial strategy projected to support 125,000 careers. We are talking about an automotive strategy designed to protect 500,000 jobs in a sector that is bleeding under Trump's tariffs. The Canadian government is essentially playing the role of fiscal shock absorber, taking on more deficit in the short term so that the economy does not collapse under tariff pressure. And the bet is paying off, at least so far. The deficit came in $11 billion lower than expected. Tax receipts were stronger than forecast. The labor market held up. Domestic demand stayed resilient. So where is the damage? Because make no mistake, there is real damage. According to analysis from the Fulcrum citing economist estimates, the 2025 to 2026 tariff cycle has reduced Canadian gross domestic product by between 1.5 and 2%. That is real money. That is real jobs. Canadian households are absorbing an estimated $1,700 to $2,000 in higher annual costs. The steel and aluminum sectors are taking serious hits. The auto sector is under enormous pressure, with General Motors alone telling investors it expects $3 to $4 billion in tariff costs in its 2026 forecast. Marty Warren, the United Steelworkers National Director for Canada, called the tariff escalations, and I am quoting his statement to the press, a direct attack on Canadian industries and workers. B. Brusque, president of the Canadian Labour Congress, called the doubling of metals tariffs a reckless move that could shut Canadian steel and aluminum out of the United States market entirely. So when Champagne stands up and talks about the second fastest growing economy in the G7, he is not telling the whole story. He is telling the part of the story that makes the government look good. The fuller picture is that Canada is growing, yes, but it is growing slower than it would have without the tariffs. And there are entire communities, especially in Ontario and Quebec, where the tariff damage is visceral and immediate. Now let me bring this back to the Trump-Carney dynamic because that is what most of you are here for. Here is what I think is really going on. Trump's central economic argument has always been that tariffs will force other countries to bend. The theory is that the pain inflicted by tariffs will be so severe that countries will come crawling to Washington, begging for deals on American terms. Canada was supposed to be the easy first win in this theory. Smaller economy, dependent on American consumers, sharing a long border, integrated supply chains. If anyone was going to crack under tariff pressure, it should have been Canada. And yet, here we are. Canada is the second fastest growing economy in the G7. The deficit is lower than expected. Direct investment is flowing in at G7 leading levels. And Carney, far from begging Trump for relief, is publicly telling Canadians that the relationship with the United States is now a weakness to be corrected. That is not the script Trump wrote. That is not the script anybody in the White House wrote. What this means, in my analysis, is that Trump's tariff strategy has hit a real wall, at least with respect to Canada. The wall is not military, the wall is not diplomatic, the wall is fiscal. Carney has the cleanest balance sheet in the G7. According to the IMF, Canada is in the strongest fiscal position of any G7 country. Nigel Chalk, the director of the IMF's Western Hemisphere Department, said in an interview with Bloomberg that across the group of 7, Canada is probably in the strongest position fiscally. That is the comparison that should keep Washington up at night. Because while the United States is running enormous deficits, while inflation pressures persist, while the average American household is paying an estimated $1,500 more per year because of tariffs, Canada is running smaller deficits than expected and absorbing the tariff shock through targeted government investment. That is a structural advantage that Trump cannot easily neutralize with another executive order. And there is one more layer to this, which I think is the most important one. Look at the trade talks. CUSMA negotiations are stalled. They have been stalled for more than a month now, according to multiple reports, including Bloomberg. Carney met Trump briefly at the FIFA World Cup draw in December, but, according to his office, they did not meaningfully discuss trade. In April, Carney told reporters at Parliament Hill, and again I am quoting from the official CBC transcript, that it is not a case of the United States dictating the terms. He said Canada has made counter-proposals, that the time will come to roll up sleeves, and that negotiations can arrive at a mutually successful outcome, but it will take some time. Read between those lines. Carney is saying he is not in a rush. He is saying Canada will not be pressured into a bad deal. And he can say that because the economy is not collapsing. The longer Carney can show growth, show fiscal discipline, show capital inflows, the more leverage he holds at the negotiating table. Every month that Canada grows faster than expected is a month that weakens Trump's hand. Now, fair disclosure, there is a domestic political dimension to all of this. Conservative leader Pierre Poilievre and his supporters have been hammering Carney for not getting a trade deal done. They argue Canada has made huge promises and delivered nothing concrete. They point out that Carney removed many of Canada's retaliatory tariffs on American goods in August 2025 and ask what Canada actually got in return. These are legitimate political critiques. The trade deal has not been signed. The sectoral tariffs are still in place. Some industries, especially small steel mills and aluminum smelters, are genuinely struggling. So this is not a flawless picture. But the economic numbers tell us something the political fight does not. The Canadian economy is, against the odds, holding up. And that is news, regardless of which political team you root for. One more thing I want to highlight, because I think it gets lost in the day-to-day news cycle. Canada's strategy is fundamentally a long-game strategy. Trump's tariff strategy is a short-game strategy. Trump wants quick wins, dramatic concessions, photo opportunities at the Resolute desk. Carney is playing for 2030. He is building infrastructure, attracting capital, diversifying trade partners, investing in critical minerals, expanding the Major Projects Office. He is signing trade deals with the European Union, deepening ties with Asia, courting indigenous equity partnerships in major energy projects. He is, in essence, betting that he can survive Trump's term in office and emerge on the other side with a Canada that is structurally less dependent on the United States. That is the play. Whether it works depends on 100 variables, including who wins the next American election, whether the Supreme Court continues to strike down parts of Trump's tariff regime, as it did in 2026 with the IEEPA tariffs, and whether Canadian businesses can actually pivot their supply chains fast enough. But the play is in motion, and the early returns are better than almost anyone predicted a year ago. So let me wrap this up with what I think the bigger picture really is. Trump bet that tariffs would force Canada to fold. Canada did not fold. Canada absorbed the punch, redirected its trade, attracted record investment, and is now growing faster than every other G7 economy except the United States. That does not mean Trump's tariffs have failed in the broader sense. American protectionism is collecting revenue, it is altering global supply chains, and it is reshaping the United States economy in ways that may benefit some American workers in some sectors. But the specific bet that Canada would buckle, that bet has not paid off, not yet. And the longer it does not pay off, the more it changes the dynamic between Washington and Ottawa. Trump may still hold the bigger gun, but Carney is showing he can take a hit. And in geopolitics, the ability to take a hit and keep walking is its own kind of power. What do you think? Is Carney's strategy working, or is this just a temporary buffer before the real damage hits? Are the IMF numbers a vindication of his approach, or just a delayed reaction to inevitable pain? Let me know in the comments below, because I read every single one. And the perspective from Canadians on the ground and Americans watching this trade war unfold is one of the most valuable parts of this channel. If you found this analysis useful, hit the like button, subscribe so you do not miss the next breakdown, and ring the bell so you get notified the moment a new development drops. There is a lot more coming on the Trump-Carney story in the weeks ahead, and you are going to want to be here for it. Until next time, stay informed, stay sharp, and I will see you in the next analysis.